All right, in this explainer, we're going to tackle a really critical piece of the new Income Tax Act 2025. I'm talking about Section 1117. We're going to break down exactly how this section handles financial losses when we're talking about major bank reorganizations.
Okay, so let's kick things off with a pretty high-stakes scenario. Picture this. A major bank is right on the edge of collapse. The government has to step in, right? And they arrange a merger with a healthier, more stable bank. Now, the huge question, the one that everyone's asking is, what on earth happens to the crores and crores of losses that failing bank has racked up? Do they just vanish into thin air? Or, and this is the interesting part, can the bank that's doing the acquiring actually use those losses to lower its own tax bill down the road?
So here's our game plan for today. We'll start with the puzzle behind these banking bailouts. Then we'll introduce Section 117 as the answer. We'll look at who it covers, the all-important loss carry-forward rule, run through a practical example, and finish up with some key compliance takeaways for all you professionals out there.
So let's get right to it. What's the core problem here really? Well, when the government has to orchestrate a merger to save a failing bank, the tax implications are, well, they're massive. You see, without a very specific legal framework, the whole process could just be chaotic. It might even scare off healthy banks from helping out in the first place. And that's exactly why a special rule like this is absolutely essential.
And the answer to this whole puzzle, it lies right here in a special provision of the Income Tax Act 2025, Section 117. You know, you can think of it as a specialized surgical tool in the tax code. It's designed for one very specific job, these high-stakes financial rescues.
Now let's be clear, this section isn't for your run-of-the-mill, everyday merger. No way. It's a highly targeted provision built for very specific, very high-stakes situations in the financial world.
So, what gives Section 117 its power? Well, it all comes down to something called a non obstante clause. The legal text literally starts by saying, irrespective of anything contained in Section 116. What does that mean in plain English? It means it acts like a trump card. It just overrides all the usual, much stricter rules you'd find for standard company mergers. Its purpose is crystal clear, to make sure the losses from the failing bank can be passed over to the new, healthy bank, smoothly and without a hitch.
To really get a feel for how special Section 117 is, let's put it side by side with the general rule, which is Section 116. You see, Section 116 is packed with all these strict conditions for carrying forward losses in a normal merger, things like asset holding, business continuity, you name it. But Section 117? It just slices right through all that red tape. It basically says, look, a government-led rescue is not a normal business deal. This is a critical mission to protect the whole financial system.
Okay, so this is a powerful tool for sure, but, and this is a big but, it's not available for just any old merger. The law is extremely specific about who gets to use it. So let's break down exactly who is covered.
So eligibility is really tightly defined. We're talking about three specific scenarios. First up, banking companies that are merging under a scheme sanctioned by the central government, as per the Banking Regulation Act. Second, we have what are called corresponding new banks, which merge under their own specific acts from 1970 or 1980. And third, it also covers government insurance companies that amalgamate under a government scheme. The main takeaway here, if the government isn't officially behind the wheel of the scheme, Section 117 is completely off the table. It's a non-starter.
All right, now let's get to what is probably the most critical detail of all. How exactly do these losses get carried forward? The law sets a very, very clear time limit. Think of it as the 8-year clock. Yep, the magic number here is 8. The law allows the accumulated business loss to be carried forward and set off against profits for a maximum of 8 assessment years.
And here is the most important point, the one thing you really have to remember. It's the start date for this 8-year clock. Listen closely. The clock does not start on the date of the merger. I'll say that again. It does not start on the date of the merger. So if Bank A has a loss in, say, tax year 2024-25, and then merges 2 years later, Bank B inherits the original timeline. That clock started ticking way back in 2024-25. That means the benefit is gone for Bank B after the 2032-33 tax year. The timeline just keeps on running.
It's also really important to know what exactly can be carried forward. The law is specific about two things. First, you have accumulated loss. Now, this means business loss only. Speculative losses do not count. And second, there's unabsorbed depreciation, which is basically any depreciation allowance the failing bank wasn't able to claim. From the day of the merger, the new bank gets to treat these two items as if they were its own right from the start.
Okay, so that's enough of the theory. Let's put this into practice now. We're going to run through a clear, simple example with some numbers to see exactly how these rules play out in the real world.
So let's look at this. We have Bank X, and it has a massive 800 crore loss from the tax year 2024-25. 2 years later, it merges with Bank Y under a government scheme. Now, because this falls under Section 117, Bank Y gets to inherit that entire 800 crore loss. It can start using it to offset its own profits right from the year of the merger. But, you guessed it, you have to remember that 8-year clock. It started ticking back in 2024-25, which means the benefit is all used up after the 2032-33 tax year.
Okay, for all the professionals and students watching, this next part is especially for you. Let's switch gears and focus on the practical side of things, the critical compliance points, and, more importantly, the common pitfalls you need to avoid when you're dealing with Section 117.
Okay, first off, and I know I sound like a broken record, but you have to track that 8-year clock from the original year of the loss, not the merger. It's the most common mistake. Second, your documentation is everything. I mean everything. The government scheme is your legal proof for this benefit, so it needs to be perfectly maintained. Third, and this is a really crucial point, the new 2025 Act doesn't magically fix old mistakes. If a loss couldn't be carried forward under the old 1961 Act, maybe because of a late return, well, it's still ineligible under the new law. And finally, don't forget that the loss keeps its original identity. A business loss for the old bank is treated as a business loss for the new one. No reclassification.
Now, for those of you who've been around the block and have worked with the 1961 Act, this whole concept should feel pretty familiar, right? Section 117 isn't some radical new idea. It's basically a direct continuation of the same principles we had in the old Section 72AA. This is all about ensuring consistency and making the transition smooth for everyone.
So, let's bring it all home with 4 key takeaways. First, Section 117 is a special rule for very specific government-led mergers of banks and insurers. Second, its main job is to override the stricter general rules you'd find in Section 116. Third, that 8-year rule is everything, and it always starts from the original year the loss happened. And finally, the whole point of this provision is to create financial stability by letting the new, healthy entity absorb the old one's losses. It's a seamless transition.
And that brings us to a final big-picture question to think about. When you create a stable, predictable tax treatment for these massive losses, how does that actually help future government-led rescues? How does Section 117 encourage healthy banks to step up and help out? Really, how does this one small section of the tax code help strengthen the entire financial system? Something to chew on.
And that's a wrap. Thank you so much for watching. If you found this useful, please do us a favor and hit that like button, subscribe, and share it with your colleagues.
Just a quick reminder, of course, this video is purely for educational purposes and isn't professional advice. Tax laws can and do change, so please always consult your professional advisor before making any decisions. This is an AI-generated educational video.